Hi, everyone, and thank you for joining us. My name is Michael Griffin, and I'm the Managing Director of Broker Solutions here at LightBox. I have the pleasure of being your moderator today for what I know is going to be a very insightful discussion. So let me set the stage as we get started. In Q3 of 2022, market conditions shifted dramatically, at least from what commercial real estate saw earlier in the year. In fact, it's amazing to see what happens so quickly. And now every year around this time, Lightbox conducts a big industry-wide survey to help us better understand our clients' state of mind about their business today and to reveal their expectations for the future. We recently published the Lightbox Fall 2022 Investor Sentiment Report with some pretty eye-opening conclusions. And today we're fortunate to have four industry experts who are going to help us interpret the results of this report. They'll also provide their personal insight on the factors impacting the near-term market. So let me start by giving you a quick introduction to our panelists. So first up is Lightbox Principal Analyst Dianne Crocker, who spends a lot of time interfacing directly with Lightbox clients. She's got firsthand experience with a broad spectrum of folks in the market. Next is broker Sean Fulp, who is vice chair at Colliers in Los Angeles. And Sean specializes in sale transactions across the Western US and has been in the industry for almost 20 years now. Then we've got Nguyen, who is the Director of Investor Relations and Marketing for Sentinel Net Lease in Virginia. Now, she focuses on the company's investor communications and marketing strategies and has a deep experience in just about every facet of the business. And finally, we've got broker Jeff Cole, who is vice chairman for Cushman and Wakefield. And Jeff has over 37 years of commercial real estate experience and has represented over 82 million square feet of commercial and office and industrial space and has executed over 250 sale transactions. Now, as we get started, let me give you some quick tips for getting the most out of this presentation. First of all, we'll be recording everything. So don't worry if you miss something, as you'll be able to review it later. And also, we do want to hear from you over the next 30 minutes. Use the comment section, and we'll try to get to any questions at the end. Okay, so let's move on to our panel, and let me start with Dianne. So Dianne, it's probably no surprise to anyone that our Lightbox Sentiment Survey would contain some pretty dramatic assertions about the market. Now, you are our in-house guru related to the economy. So what do you think the survey implies about our clients' perception of the direction of the industry?
Yeah, thank you, Michael. And you're right. Our industry runs on sentiment, right? And I think for me, reading the results, it was really clear that the third quarter of this year marked a turning point in market confidence. And as you mentioned, we cast a broad net with this industry survey to include our clients in segments they're really at the leading edge of transactions, whether it's environmental due diligence or appraisals. We have brokers, and they all get involved before deals close. So, in my mind, in looking at the results, the importance is that they're at the front lines, and what the results are telling us about sentiment is a solid early indicator of where our market is headed. So having said that, I think, I agree with what you said in your intro. There's definitely been a real palpable change in tenor in the market, certainly since we did this survey at the start of the year. And I think, it really reflects the abruptness of the increase in interest rates after such a long period of time when they were at historically low levels. So we're asking the market to adjust to a lot in a very short time frame. And, think about how much has changed since the New Year's forecasts. Virtually all of those forecasts were obsolete by the time that we were going on summer vacation. And in fact, the survey showed that many of our clients, for example, 47% of environmental due diligence professionals saw a decline in their third quarter business activity. So, it wasn't surprising to me that the results show that the bears are winning over the bulls. Certainly there's more caution in the market now than optimism. I think one of the things that surprised me in the results is that when we asked respondents, how do you feel about expectations for commercial real estate for the balance of 2022 and for 2023, 50% were concerned about the balance of 2022, while only 36% were concerned about next year. So, could suggest a couple things. It could suggest a perception that what we're in right now is kind of a short-term tap of the brakes versus something kind of more worrisome and long-term, or it could be wishful thinking. Who knows? But I was just a bit surprised by that, given all the headlines about the worst is yet to come. But just to close out here, I think there's so many nuances in our market, and subclasses or subsegments of asset classes in different areas of the country are performing very differently. So that's why I'm grateful to hear what Sean and Laura and Jeff have to say, because they're really at the front lines on leasing and buying decisions, and that gives a really good read about how firms are viewing their need for space in an uncertain market, Michael.
Well, that's great. Thank you for that. Let's hope all that optimism comes to fruition. And so now let me move on to Sean. Sean, you do a lot of work on the office side and probably have a better sense for the pulse of that sector than anyone. And the last couple of years have had an unprecedented impact on office, and there's confusion and uncertainty about the impact that the new hybrid work model will ultimately have on office vacancy rates and pricing. So what kind of impact have you personally seen? And what do you think the shifts in office utilization really means for this sector?
Well, I thank you, Michael. I think it's unknown, but what's happening now is we're finally seeing companies make decisions, which we hadn't seen for the last couple of years. And whether that's we were going to give back our space altogether, we're going to downsize, whatever it may be, those decisions is what we need to get that clarity on how to kind of forecast and predict moving forward. I think that the way space is going to be used going forward, I think the key word is flex. We're seeing that with flex schedules, hybrid work models, but we need the companies need flex space as well. They use a space one way on Monday. They might use it completely different on Wednesday. They have production space. They have lab space. They might have meeting room space, multifunctional space, conference room space. And that's going to just change the design of office. And I think buildings are changing as well with the design of it. And it's really, I see it as an evolution, and there's going to be disruption. There will be pain. There's going to be a lot of costs to change the way office looks in the future. We see that with inflation and what's happening with costs and tenant improvement costs and everything that we've already experienced. But I think the future of office over the next 2 or 3 years, you think how long it's been through COVID so far, it's a reset, but I think the future is promising. I think the future of office and buildings in 2 or 3 years are going to be just higher end, more experiential. The TI costs are going to be substantially more than what they are today. And I just think that coming out of this, we're all going to have a better office experience. And we were kind of talking about this previously, but I think employees are basically protesting right now and voting with their occupancy, saying we don't want to come into these old spaces any longer, provide us a better experience, and we'll show up. And I think that's going to be positive for the sector altogether, though.
I like that, voting with your physical presence. That's good. Okay, the next one is for Laura. So Laura, let's continue with this with office theme that I started with Sean. You have a unique perspective because of your focus on the portfolio management side. So all eyes are on office occupancy right now, and that story is still being written. So let me ask you, what sort of dynamics are evolving from the tenant's perspective, and then what kind of new challenges do landlords face because of this? I think you're muted.
technology got me. Thank you. Sorry. Thanks, Michael. Yeah, I think for us and where our focus has been, in the Midwest, it was a little bit different on the restrictions that were given passed through for COVID. So where offices in high urban density areas were vacating completely, we may not have seen we may have been on a hybrid schedule, but employees were still coming in, 3 days a week versus 5 days a week. And also too, in some areas like in Florida, we never saw any vacancy. So I think that it just sort of depends on where your market is. I think that what we're starting to see now is with leases that are coming due for a renewal, it's giving the tenant an option to renegotiate. And should their office needs spaces have changed, and also the way that their workforce wants to work, they are looking for, either less space or for improvements to lobbies or for amenities for their employees to go outside. We're seeing a lot of green space and blue space requests, meaning the employees don't want to be inside. We've been working from home. We want to come and get things that we might not be able to get in our own home office. So, that brings a whole new perspective to when you're looking at leases and looking at these renewals. And to Sean's point, the TI packages, and to get that renewal, what is it going to cost you? So we're seeing some of that. I think too, when we are looking to acquire, we're really paying attention to those leases where there may be some one-time termination clauses or anything that gives the tenant the ability to give back space at a certain time. It's certainly part of our diligence, but we're also seeing that come across in our debt financings too, where they're looking for those specifically.
Yeah, so it sounds like tenants still have some uncertainty about even what their business is going to be doing in the next, near term. Okay, so now a question for Jeff. So Jeff, I think that I've seen your name on some of the biggest industrial deals that have come through our RCM marketing platform. And there's obviously been a very different COVID story with industrial, which has led the recovery with low vacancies and double-digit rent growth. But at some point, presumably, the market has to cool off. So are you seeing any change in sentiment yet? And more specifically, are investors impacted by higher borrowing costs?
Well, yes, as your survey noted, there's been a rather drastic change in investor sentiment just in the last, I would argue, 90 to 120 days even. And we're seeing it throughout the sector. And you're right, it's been a darling sector because of e-commerce demand, and it's really the need for warehouse and distribution space, which has been driving that sector for a couple of years now, certainly more than that, but certainly since COVID. So what's changed though is three things. We've touched on a little bit already. One, just the overall economic concerns have certainly have drifted into the psyche of investors, and certainly institutional investors. I just got back from a conference, the Urban Mind Institute conference in Dallas. We were in a room of about 50 REITs, pension fund advisors, lenders from around the country. 80% of those people in the room thought we were going into a deeper recession in 2023. I know that your survey was around 50%, so that's even higher on the institutional level of concern. Inflation is another area that's also drifted into our market, and I'll talk about how that's impacting pricing on the industrial side. Inflation concerns, and that's mostly manifests itself on leases that are longer term, that are already in place, where the standard annual bumps, for example, on a lease around the country, I think it was 2% for any lease that was signed more than 3 or 4 years ago. Today, with inflation, driving, up to 6, 7, 8% or higher, those investors are basically deferring in many cases from the long-term leased assets that have those annual bumps because they're feeling they're going to be being hurt and being discounted because of inflation going forward. And the most important, as you just mentioned, reason that's moved the sentiment and also pricing is interest rate movement. The interest rates that on deals that we've transacted on the West Coast, our team of about in the last 120 days, about 30, 40 transactions. Those deals we were getting debt quotes on industrial deals in the 3 to 4%, fixed rate debt back in the spring. Today, we're getting debt quotes in the 6 to 7% range. So that's pretty significant. I just read today that the national mortgage rate for homes is now at 7%. So that is definitely impacting pricing, even though a lot of our business is all cash business, but it definitely reflects pricing for even cash buyers. So to give you a quick summary of what's happened just in the last 120 days, at least on the deals we've worked on out here on the West Coast, Seattle down through Southern California. And this is pretty similar around the country. The long-term single-tenant leased asset has been hit the most, about 150 basis point increase in cap rates just in the last, again, 90 to 120 days. That's significant. Average deals that we were doing around 3.5%, 4% cap rates back in the spring. We're now doing, those deals are 5.5% to 6% on the long-term lease. Single core Class A assets, more traditional industrial space, those cap rates are up about 100 bips. Maybe in some cases a little more depending on the market and the product. And then the product type that's been impacted the least, even though it's moved as well, have been, I would call, your multi-tenant, mark-to-market, short-term leased assets that allow you to get to increasing rents in a shorter period of time. Those cap rates have moved, but not as much, maybe in a 50 to 100 bip range, depending on where they are. That's the important thing about industrial versus office, which Sean talked about, is that industrial markets fundamentally are still performing really strong. Almost every major market in the West Coast has historic low vacancy, and they're still having strong absorption and rising rental rates, most importantly. And trending 12 months, many markets still have double digits, sometimes up to 20% rent growth over the last 12 months. So that's driving, at least keeping, I would say, industrial, especially short-term rollover product, relatively speaking, attractive.
Wow, that's amazing insight. All right, let's move back to Dianne. So Dianne, as you know, one of the big questions we posed in our sentiment survey was related to the community's opinion on this, likelihood of a recession. And the results indicated that 35% of our respondents are very concerned about a pending recession, and even another 55% are somewhat concerned. So you talk to a lot of people. What's your sense for where we're headed and how this might affect our industry?
Yeah, it's a good question. I mean, certainly the R word comes up in every conversation that I have with our clients these days. I hope many of them are listening to what Jeff had to say, because if they're working in industrial, I think they're going to feel pretty good right now. But that 90%, who are concerned or somewhat about recession is pretty consistent with a KPMG CEO survey that also just came out, and I think, I'm an economist at heart, and I think, the reality is that the market's just really confounding right now. We have so many conflicting signals. There's persistent inflation, which, we've already talked about. We've got a very hawkish Federal Reserve who's trying to control it. But corporate earnings haven't really taken a hit yet. Unemployment is still low. Consumer spending has been really resilient. Fun fact from my friends at JLL today is that Halloween spending this year is projected to reach a record $10.6 billion, which breaks last year's record. So my point is stats like that don't really suggest that we're in a recession. But the reality is we don't know where the Fed's going to land with rates. It's a safe assumption they're going to go up more and more until the Fed gets a sense that it's working and that inflation is starting to ease. So the impacts are going to continue based on what we've already seen in the third quarter. Access to debt capital will be more limited. Safe to assume it will thin the buyer's pool as some are just shut out of the market. I think it will make some investments less viable. They're not going to pencil out the way that they might have when capital was cheaper. And I think in thinking about deal dynamics, no longer can you assume in some sectors that price appreciation is a foregone conclusion, and the market has been able to enjoy that for quite some time. So that's a pretty significant change. So I think, the best you can do is prepare in a murky market. And I think our clients are bracing for the worst and hoping for better. But, in my opinion, one of the best things about our market is that there's always opportunity in commercial real estate. And in times of uncertainty like we're in right now, there's a real flight to quality. And that's a point that my colleague Tina makes in the report, which is the market fundamentals are still supporting a range of investment activity, and buyers are looking for investment bright spots in hazy conditions. And I think, in making decisions about investments in today's market, the numbers matter more. And so you've got to really look at the assumptions about NOI, about rent growth, about occupancy, about operating costs. And I think, anybody who's in the business of helping investors and lenders kind of sift through the uncertainty and manage risk, now's really their time to shine. This is when deals need to make sense, and it's a real opportunity for those who are trusted advisors and supporting transactions. So, I mean, maybe we're in a recession, maybe not. You can argue that. Maybe it'll be short-lived, maybe it won't. But I think what happens most of all is what's happening in our markets and where the strongest opportunities are, and using the data that you have at hand to make smart real estate deals.
Yeah, that's great. Thanks, Dianne. Okay, back over to Sean. So, I mean, I don't know about everybody else, but I was a little surprised that foreclosures and auctions weren't more of a factor during COVID. And I guess one thing, that was different is that we were never faced with a broad economic decline. But whenever a downturn is ahead, the chatter about distress always starts. So, Sean, what do you think this means now for the office sector? And do you expect to see distressed assets surface in response to the stresses of high interest rates and inflation?
Yeah, we're definitely going to see distressed. There's plenty of stress and distress in the system already. Now we've got a higher cost of capital. COVID, the cost of capital was brought down, so that preserved a lot of the assets and situations with those particular assets. But it's inevitable. The fundamentals are softening. Vacancies going up, rates are going down, sentiments worsening. So yeah, we do expect to see distress, but if you look at the trigger events around what causes distress or what creates distress, usually comes with loan maturities, and we don't have that wall of loan maturities that we were expecting and coming out of the GFC. So maybe it'll be more orderly this time around, but we also, we got a bigger issue with regard to office and how office is being used, and that needs to be dealt with. So we expect that there will be the B buildings, the commodity office space that will struggle. The better located, higher quality office buildings will thrive, and there'll be reinvestment in those buildings. But you can see is office as an asset class, it takes more capital to operate. And if the valuations aren't there, you won't see investors invest in those buildings, and you won't see lenders want to operate or invest in them as well. And so there will be liquidation, and it should happen fairly quickly with rates increasing as fast as they have and the fundamentals where they are. We expect that you'll start to see a lot of that distress or signs of it come next year. And it starts with cash management, lock boxes. You start to see ownership not invest in the CapEx that they normally would invest in. So as budgets are being prepared for next year, replacing roofs or mechanical equipment or whatever it may be, that might just not get done. And so it's coming though, and but it'll be a good thing for the industry because it'll help reset basis, and we can have this actually be dealt with.
Yeah, that could be a very interesting 2023. Okay, so let me ask Laura. Laura, I'm sure everyone is really interested in your take on the finance side of the business, considering Sentinel's focus as as an investor. So taking into account everything Sean just told us, along with everything you're seeing for yourself, how do you think the dynamics are changing in the lending environment?
They certainly have changed, and they change daily now. I think, it was every 30, 60 days. Now we're seeing it change fairly quickly. I think that everything that Sean just said is the lenders are going to be taking on a lot less riskier assets in the Class B, Class C for sure. But, Class A seems to be still doing okay. The issues are the larger lenders are on pause. Life companies can put their money somewhere else and get a predicted return rather than putting it into something that might have a little more risk. So things like the lock boxes or springing triggers based upon leases. And like I talked about earlier, those one-time termination clauses adding in reserves and larger reserves than what would have may have been typical for CapEx items on a building. If you've got some deferred maintenance, they're going to have you start reserving those. So, the deals I think are still out there to be had. I think it's going to come down to relationships and where you can forge those relationships and work with your institutions that have backed you before. Because I will say that, having come out of our recent, Crew Network conference in a room with a bunch of Bank of Americas and Citizens and things like that, they're all just kind of paused on office right now. So I think that we're going to be looking to go to some of our relationship banking.
That's great. All right. Thanks, Laura. All right. Now over to Jeff. So let's wrap up by trying to understand, Jeff, what's ahead for industrial. So I've got a two-part question for you. So first, what effect will the changing economic landscape have on plans to build out the supply chain, capacity problems that we all hear about? And secondly, what's the inside scoop on the mindset of the large regional landlords that you're working with, and how are you advising them today?
Yes, that was a great question, and I'm not sure I have an exact answer because it's changing almost daily or weekly for sure. But I would say as far as the first part of the question on the capacity to build the build out of the supply chain, that doesn't seem to be slowing much at all in the major markets that we cover or around the country, especially the port-related markets like New York, New Jersey, Savannah, Seattle, and certainly Southern California is the largest port in the United States. So those markets and the development pipeline has not slowed down. We don't think that's going to change in the short run, anything dramatically. Land sales have slowed as far as certainly because of pricing, but not because of the demand. So the pricing is being, I would say, to answer your second part of your question, which is how are the big regional, national landlords looking at the product going forward? I would say right now, there's a good chunk of those clients that we deal with, mostly REITs and pension fund advisors that own a big chunk of industrial, certainly on the West Coast. Those groups are right now, and I would characterize as kind of a wait and see kind of attitude. There are certainly a lot of groups with pencils down or trying to discover really where pricing is going. They don't seem to have a fear that the industrial market still has demand. As I mentioned earlier, that seems to be sound, but I think the unknown about where interest rates are going to go into the coming 12 months, even further. A lot of it's already been underwritten into pricing. It's already moved, but I think there's a lot of groups still trying to figure out, why do I develop or buy now when I can wait 6 months and it might be better? There's a lot of that going on right now. So I would say, generally speaking, it's cautious, but I think the outlook is still positive. I mean, there's, if you really look at the headwinds that industrial has versus the other product type that we've talked about, it has, let's assume we're going into a recession like a lot of people believe, or a deeper recession than a lot of people believe. We're currently nationally are still at an all-time record low vacancy, not only regionally, but nationally at around 3.5% to 4%, depending on who you listen to. If we didn't lease one, this is a great statistic, I just heard this week. If we didn't lease 1 square foot of everything that's being developed right now, we would, and we would still have a lower vacancy rate than we did at the last peak, which was in 2007. So that's hard to believe when you think about that, how much more stronger we're going into this recession than the last time. We also have the other thing that drives industrial is consumer spending. Right now, the other metric that a lot of people track, our economist does, is household savings, which is also at a historic high. That also bodes well for industrial in downturn when people, even during COVID, this was a good example, when people are buying online, still going to be a driver of e-commerce, warehouse and distribution product. So I think we're generally fairly bullish. The clients are fairly bullish, but they're in kind of a pause mode as far as where pricing is going to land out, mostly because of interest rate movement.
That's amazing, especially that vacancy stat. Okay, so we're about out of time here, but Alyssa, if you could just pop everybody up, and I want to do a quick little round robin. I have 3 questions to ask you, which I'm sure everybody will be interested in terms of the response. And these are one word sort of responses, so don't feel like you have to expound on anything. But so here you go. So the LightBox survey found that 70% of the respondents were concerned or bearish about the market for the balance of 22 and 58% for 2023. So what are you, bearish or bullish? So I'll go around the horn. Jeff.
Bearish for the rest of this year, bullish for 23 for industrial.
All right, Sean.
Generally bearish, but it's changing. I think October it's one word, so bearish.
All right, Laura.
We're bullish.
All right, and Dianne.
I'm bullish with a few caveats.
Excellent. All right. Next one. It seems like every day I read economic headlines like, the worst is still to come. But it seems like, Dianne, as you mentioned, the market fundamentals are still pretty good. So how worried are you about a deep recession? And for your response here, maybe use, low, medium, or high, where high is, you're really fearful. So Jeff again.
I would say more bearish than bullish in the short term.
All right, Sean, how about you?
I would say I'm bullish.
All right, and Laura?
I'm pretty low. I think it's more emotion than it is reality.
Okay, and how about Dianne?
I'm still bullish on that too.
All right. Okay, last question. So what is the impact of midterm elections on the industry, assuming things go, whatever way you think? Is it going to be good or bad, for your respective sectors, or neutral? So Jeff.
I would say potentially good, assuming there's going to be a change in one way or the other that would impact, I think, inflation concerns that it could be with a new Congress could be a little better under control.
All right, Sean?
I think it's so close, it's already been built in. So I think we're realizing it.
Okay. Laura?
I think it's going to be good. I think that whichever way it goes, it's definitely a high priority.
And Dianne?
I think good. I think it has more to do with what the Fed does than what the midterm elections show, honestly.
Yeah. All right. Thank you, everybody. Well, that's it. I hope you enjoyed our discussion. This was really, really great. And I want to thank our esteemed panel for giving us their time today. And everyone, please keep your eye out for a recording of this session and feel free to reach out to any of us with questions. Thank you for attending and have a great day.
Thank you. Thanks, everybody.
Thanks, everyone.